Hi, this is Bo Cook. Today we're discussing construction loans. Not entirely different to a normal loan. There are a few things that differ to what you're probably expecting, and this should hopefully debunk any false expectations. If you're buying house and land, in this video, assuming that part is settled, your land loan is organised already and in place, you've found a builder and you've locked in a price with them, and now you're ready to get things moving with the building side. In your contract with your builder, you will more than likely have a section titled Progress Payments. In this section, the builder is broken down into different stages or milestones that will be reached as work progresses on the build. The different stages are when the concrete slab is poured, next one is when the frames are installed, then you've got your brickwork or whatever exterior material you are using. When this is completed, also commonly referred to as lockup, that's another stage. Then you've got your plasterboard is installed. This is the gyprock sheeting inside of the house. And then finally practical completion, which is when everything that is left is completed. Once each milestone is reached, the builder will send you an invoice for the work completed for that stage. The amount charged is a percentage of the total cost though, rather than the actual cost of the work completed. Once the slab is down, you can expect to pay 20% of the building's cost, then another 25% once the frame is up, and then this continues until the house is completed, and 100% of the cost is paid to the builder. Every time the builder sends an invoice, the bank checks that the work has been completed and the amount charged is added to your construction loan. It may sound like it will take a while for the progress payments to add up, but the first four happen in relatively quick succession and the loan is 90% funded before you know it. Construction loans are interest only until completion. This means you aren't reducing your loan at all, you are only paying the bank their cost. Being a loan market franchisee, have access to about 62 lenders, and I believe 3 of those offer principal and interest repayments during construction. Interest only is the standard procedure for construction. The positive of this is that you have a bit of extra cash to be able to pay rent, land loan if you have it, and then the construction loan as well. It's hard to give an accurate number here as interest rates differ and every situation is slightly different from the other. But the difference between principal and interest to interest only on a $400,000 loan is about $500 a month. Once construction has finished, the loan switches over to principal and interest. At this stage, you can combine the two loans if that's what you want to do. You may also decide you want one loan to be on a fixed interest rate and the other to be a variable rate to ensure a bit of certainty around repayments, but also to maintain the ability to make unlimited extra repayments on the variable portion. There's definitely a few options here to consider regardless. That's construction loans in a nutshell. I'm Bo Cook. Reach out at any time if you have any further questions I may be able to help with. Thanks for watching. Hope you enjoyed this.